Donald Trump just dropped a bombshell that could fundamentally rewrite the rules of the American neighborhood. On January 7th, 2026, he announced immediate steps to ban large institutional investors from purchasing single-family homes, and he's calling on Congress to codify it. Now, before you roll your eyes or head to the comments to start a political war, stay with me, because this isn't just a policy, it is a direct strike on the supply and demand mechanics of your biggest asset, your home. Now, before we dive into the data that's going to make some people very happy and others very nervous, I have a quick favor to ask. If you could just tap, not smash, the like button for the YouTube algorithm, it helps this channel more than you know. In exchange, I've spent the last 48 hours digging through SEC filings and housing data so you don't have to. Whether you rent, own, or simply plan to retire someday, housing policy has a funny way of showing up where you least expect it, on your monthly bills. Even subtle tweaks in law can ripple through neighborhoods for years, affecting costs you might not notice until tax season or when you open your mortgage statement. Imagine thinking your finances are safe, and then suddenly your HOA fees climb, your insurance adjusts, or your neighbor's property taxes indirectly affect yours. This is The Asian Girl, breaking down exactly what this policy means for your wallet, your home, and your retirement plans, without political shouting, without panic, and without confusing spreadsheets. Let me be clear, this isn't political fluff. This isn't clickbait. And this definitely isn't something that only affects real estate investors. We are talking about the American dream under a microscope. Let's talk about why this matters right now, not 5 years from now. Timing is everything, especially for the 50-plus demographic, looking at their homes as their primary nest eggs. Since the 2008 crash, firms like Blackstone and Invitation Homes have treated single-family houses like stocks. If single-family rentals are restricted, the immediate buy pressure from these multi-billion-dollar funds disappears. When you have less supply with the same demand, prices go up. But in this case, we're talking about removing demand from the top 1% of buyers. That sounds like a dream for your kids trying to buy their first home, right? But for you, rising rent tends to ripple through everything else: property values, property taxes, insurance costs, and cost of living adjustments. Think of it like a stone thrown into a pond. The splash is the policy, but the ripples are what hit your bank account. In some cities, when institutional buyers leave, it can actually tighten rental inventory because these firms were the ones providing the units for rent. If you are a homeowner, slower home appreciation may sound good if you're trying to buy for a grandchild, but it's not so great if your house is your retirement plan. Slower growth limits your options for downsizing, relocating, or using equity to cover unexpected costs, such as healthcare or elder care. For many Americans over 50, a home isn't just a place to live. It's a savings account and a backup plan. Spreadsheets plan a reality that doesn't always RSVP to your retirement party. To understand the future, we have to look at the crime scene of 2008. After the subprime mortgage crisis, regular families couldn't get a loan. Enter Wall Street. They had the cash, and the government actually encouraged them to buy up the supply to stabilize the market. Fast forward to today, in specific regional hubs like Atlanta, Phoenix, and Charlotte, the investor-buyer share has been reported as high as 25% to 30%. When a family tries to buy, they're competing against companies that pay cash, close in days, and don't care about the school district. They only care about the yield. Families bring emotions, investors bring spreadsheets. And in a bidding war, spreadsheets usually win. The finance magic trick here is that now you see the house, now you don't. It's gone into a corporate portfolio. This proposed ban is essentially an attempt to kick that guy in the suit out of the auction to restore the American dream. But wait, if institutional investors only own about 1% to 3% of the total single-family homes nationwide, why is the stock market freaking out? Shares of housing sector firms and builders sank significantly after the announcement because, in local markets, That small concentration can be the difference between a house sitting for 60 days or selling in 6. So, how would this actually work? The proposal targets large institutional investors, often defined by researchers as entities owning 100 or more properties. The goal is to codify this into law through Congress, so it isn't just an executive order that disappears with the next administration. The policy would likely involve two prongs. First, a direct ban on new acquisitions of existing homes. Second, potential tax penalties for corporate-held properties that make it unprofitable to hold them long-term. Trump's logic is simple. People live in homes, not corporations. But here is where it gets complicated. If you ban these firms, you remove the most reliable buyer of last resort in the market. In a recession, these firms provide liquidity. Without them, if you need to sell your home fast for a medical emergency, you might find that the market is much slower. You're trading high prices for market stability. Is that a trade you're willing to make for your nest egg? Now, let's look at what I call the geographic blood pressure of the market. Because here is the reality. Not every neighborhood in America feels this policy the same way. If you live in a rural part of the Midwest, institutional investors might own 0 homes in your town. But if you're in a Sun Belt hub, think Atlanta, Phoenix, or Charlotte, the corporate pulse is racing. In these specific relocation hubs, investors have historically accounted for as much as 30% of all single-family rental stock. When a corporation with a $10 billion war chest enters your zip code, they aren't just buying a house, they are setting a localized price floor. They benefit from massive economies of scale, buying 10,000 sinks or HVAC units at a time for a 30% discount, which allows them to pay more for a fixer-upper than you or your children ever could. But removing that floor overnight creates a liquidity vacuum. We've seen this play out globally. Take a look at Rotterdam in the Netherlands, which implemented a similar ban in 2022. While it helped some first-time buyers get into homes, it also caused rental prices to spike by 4% almost immediately because the supply of rental units dried up. If you are a homeowner over 50, your geographic blood pressure matters because your net worth is tied to comps, the price your neighbor's house just sold for. If the corporate buyers leave these Sunbelt markets, those sky-high comps might start to look like sea-level comps. For someone planning to use home equity for a reverse mortgage or to fund long-term care, a 10% dip in the market isn't just a stat. It's a life-altering event. Trump is taking this big picture to the global stage, announcing he will expand on these housing measures at the World Economic Forum in Davos later this month. This signals that the policy is being framed as a structural shift in the American economy, not just a localized fix. You have to understand, in a market without buyer of last resort liquidity, your home equity could effectively be on Wall Street life support. Removing that support too quickly could leave your retirement plan gasping for air. Let's talk about the little guy. Whenever a politician targets Wall Street, they often hit Main Street too. Take a typical 60-year-old landlord, let's call him Mike. Mike worked as a teacher and bought 2 rentals as his private pension. If the government creates a climate where rentals are the enemy, Mike's compliance and insurance costs go up. If Mike sells because of the headache, he's one less small landlord in the market. This can actually tighten rental inventory. Research shows that institutional investors actually expand rental supply on net by 0.5 homes for every home purchased. Banning them could actually lead to higher rents for families who aren't ready to buy yet. And for retirees owning their homes, your net worth is tied to comps. If corporate buyers leave, those sky-high comps might start to look like sea-level comps. For someone planning to use home equity for a reverse mortgage to pay for long-term care, a 10% dip in the market isn't just a stat. It's a life-altering event. It's the difference between the premium assisted living facility and the one that, well, you get the point. Let's do a quick winner and loser scorecard. The winners, first-time buyers. your kids might actually stand a chance. Without cash-heavy corporate competition, subject to appraisal, offers might finally get accepted again. Local banks. They get to issue more traditional mortgages to humans instead of just processing wire transfers for hedge funds. The losers, the work-from-home, renter. If you want a nice house but can't afford to buy yet, your rental options are about to get much more expensive as supply dries up. The aggressive seller. If you were hoping for a bidding war to fund your yacht in the Caribbean, you might have to settle for a sensible pontoon boat. The retirement portfolio, REIT stocks, real estate investment trusts, in your 401k, took a nosedive when this news hit. What should you watch for in the next 6 months? First, keep an eye on Davos. Trump mentioned he would discuss further housing proposals at the World Economic Forum in late January 2026. This means the policy is still being shaped by global economic pressures. Second, watch the exemptions. If the law allows build-to-rent communities, where companies build entire neighborhoods specifically to rent, to stay corporate-owned, then the ban is basically toothless. Also, watch interest rates. Trump has suggested instructing Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds to drive rates down. If we have a ban on big buyers and lower rates for families, we could see a massive wealth rotation back to the middle class. But that's a big if. Panic is expensive. Information is valuable. You don't need to be a psychic to protect your wealth. You just need to understand the incentives. Bottom line, housing policy always creates winners and losers. The biggest mistake isn't buying at the wrong time. It's ignoring the rules that are quietly reshaping your money while you sleep. If you're over 50, your priority is making sure your money actually works for you. Understanding policies like this, before they roll out, is how you stay in control of your retirement. I'm the Asian girl, breaking down how big decisions quietly affect everyday money. Don't just react to the headlines. Anticipate them. Stay informed, stay ahead, and I'll see you in the next one. And seriously, go drink some water. You've earned it.
Click here to watch another video. YouTube picked it out for you based on what you like watching.